You know, it's really striking when you think about it. Just last year, 2024, a huge chunk, like 60% of the world's entire economy was linked to global trade.
60%. That's enormous.
It is. Most of what we make and buy crosses borders. But here's the thing that grabbed me. That huge engine. It's really slowed down recently.
It's
Quite
slow.
dramatically, actually.
Yeah, that's right. The way trade exploded over the last few decades, it really shaped the modern economy we know.
Mm-hmm.
So seeing it slow down this much, I mean, the slowest half decade since the 80s, that's a real signal. Something's changing, and we need to, dig into why.
Absolutely. And that's exactly our plan for today. We've got some really interesting material here, including a fresh economic update. It really shines a light on tariffs, especially, the whole U.S.-China situation.
Right. Our goal is to really unpack all that information for you, go beyond just the headlines, and figure out the key forces that are, well, reshaping how goods and services move around the world.
Yeah, understand what it means.
Exactly. We want to clarify what these shifts in trade mean for the global economy's health, basically giving you a clear, insightful take on these pretty complex issues.
Okay, so to really understand where we are now, it helps to look back a bit, right? This interconnectedness, it didn't just like pop up overnight.
Oh, definitely not. The sources make that clear.
Yeah.
The numbers themselves tell a story.
Huh.
If you go back to the 90s, trade was, what, around 41% of global GDP?
Mm-hmm.
And then, bam, fast forward to 2024, and we hit that 60% mark you mentioned. That climb, it just shows how much national economies have become woven together.
And it wasn't just more boxes moving around, was it? The impact went deeper.
Precisely. That's the key thing, how this trade growth actually fueled development.
Yeah.
Countries could specialize, reach bigger markets,
Right.
and crucially, how technology and sort of best practices spread across borders through trade. All that really boosted global productivity and, living standards.
Okay, so that makes sense. For a long time, more trade equals more growth,
Mhm.
generally. So this recent slowdown, what's really driving it?
Well, the slowdown is pretty sharp. Between 2020 and 2024, trade grew, on average, just 2.3% a year.
Only 2.3%.
Yeah. And to put that in perspective, that's the slowest expansion rate in like half a century, if you ignore the big global crises.
Wow. And it's not hitting everything equally, is it? There seems to be a split between goods and services.
That's a really sharp observation, yeah. In 2024, trade in merchandise, the actual physical stuff that grew only about 2%.
Okay.
But trade in commercial services, things like tourism, finance, IP, that shot up by 9%.
9%, that's a big difference.
Huge difference. And that divergence, it suggests maybe a shift in how the global economy works, with services becoming maybe more central. What do you think is behind that big jump in services?
Good question. Maybe digitalization? Service trees might be less affected by the kind of border hassles physical goods face.
That seems plausible.
Yeah. Now, thinking about the big picture of trade, you just can't ignore the U.S. and China. Their influence is massive.
Oh, absolutely. Their combined economic weight is just immense. In 2024, together, they accounted for like 35% of all global GDP.
35%.
And for physical goods trade, it's even more concentrated. Almost a quarter of all merchandise trade worldwide involves them. They're the real heavyweights.
And with China being the world's factory, basically, and the U.S. a huge consumer, if China's goods trade slows down, that's going to create ripples everywhere, right?
Exactly. China's role in supply chains is just so central. Any slowdown there directly hits demand for materials and parts from other countries.
Mhm.
And likewise, if U.S. consumers pull back or change habits, that impacts exports for tons of countries. Their fortunes are really tangled up with the rest of the world's.
The sources we looked at also flag something worrying. More trade restrictions popping up globally. Feels like maybe the trend towards free trade is reversing.
That's a critical point.
Yeah,
We are definitely seeing more government actions that block trade rather than encourage it.
like tariffs.
Yeah, import tariffs are a big one, or high excise duties that make imported goods less attractive. And on the flip side, things that promote trade, like, say, subsidies for domestic production. While they seem less common now, this lean towards protectionism is a big deal.
And it's not just the direct barriers. It seems like countries aren't as eager to sign new trade deals either.
Exactly right. The data shows fewer new trade agreements getting signed each year this decade compared to, say, the 2010s or before. This slowdown in building new trade frameworks, it just underlines this shift in priorities.
Why do you reckon we're seeing less enthusiasm for these pacts now?
Maybe countries are focusing more inward.
Yeah.
After the pandemic supply chain shocks, maybe there's more skepticism about deep integration, more focus on national resilience.
Could be. Could definitely be.
Now, front and center in all this tension is the U.S. and China again. It feels a bit like deja vu, but maybe worse.
Well, there are definitely echoes of the earlier disputes, but it does seem escalated. What's really noticeable now is the level of tariffs being used by both sides. Higher than before.
Significantly higher, on average, than during that first trade war. It suggests things are more dug in, potentially more damaging this time around.
And it's gone beyond just like steel and soybeans, hasn't it? The restrictions on AI chips, for instance, that feels like a whole different level.
Absolutely. That move really broadens the conflict into national security, into who leads in technology. Restricting high-tech exports, that has ripple effects way beyond just the trade balance. It impacts innovation, future development.
Yeah, long-term stuff. The report also raises a red flag about dumping from China. Can you just quickly explain dumping for anyone listening who isn't, deep in trade talk? And why is it a worry?
Sure. So dumping, in simple terms, is when a country exports goods at a price that's lower than what they sell for at home, sometimes even below what it costs to make them. The worry is that this can really hurt producers in the country buying the goods, unfairly driving them out of business. And that big jump, 33% in anti-dumping cases against China, that shows other countries are getting pretty concerned about potentially unfair pricing.
So it's not just about getting cheap stuff. It could actually mess up whole industries.
Exactly. If it happens widely, especially in key sectors like metals, chemicals, plastics, where lots of these investigations are focused, it can distort markets, create unfair competition, and then, lead to retaliation, making trade even more fragmented.
And all this trade friction, it's happening while the global economy generally seems a bit weaker anyway. That can't be helping.
No, indeed. Global growth in 2024 was definitely lower than before the trade war started back in 2017. That suggests these tensions might be dragging things down.
Mm-hmm.
Plus, you've got the huge pile of government debt from the pandemic adding pressure, and global manufacturing has been slowing since 2022 with all this uncertainty. It's all connected.
And investment flows across borders seem affected too. Less money moving around.
That's right. We're seeing a drop in global foreign direct investment, FDI, especially into developed countries, though not so much the U.S., interestingly.
Huh.
But elsewhere, yeah. This reluctance to invest across borders could be down to geopolitics, protectionism, companies rethinking where they make things. What do you think that drop in FDI might hurt the most long term?
Maybe it slows down the spread of new tech and ideas. Especially in those developed economies seeing the biggest drops, that could hurt innovation down the line.
Good point.
Now, shifting focus specifically to the U.S., the report talks about inflation risks from these higher import tariffs.
Yeah, and the link is pretty direct. Tariffs make imported goods more expensive, right?
Right.
So that can push up prices for consumers and businesses. And that survey from March 2025 showing people expect higher inflation, that kind of fits with this concern.
Right.
And when you see proposals for even more U.S. tariffs on goods from various countries, well, the potential for broader inflation pressure just grows.
So these trade policies could actually end up costing American shoppers more at the checkout.
That's a very real risk, yeah. And we're already seeing trade patterns shift. Like the U.S. trade deficit with China, it's gone down since 2021.
Okay.
But at the same time, the deficit with places like Mexico and Vietnam has gone up. It suggests supply chains are sort of rerouting.
Interesting. And what are the big forecasters like the Fed or the IMF saying about U.S. growth amidst all this?
Well, they've put out their 2025 projections, and it's notable that the IMF's forecast seems to factor in potential negative hits to U.S. GDP growth because of these tariffs.
Ah, so there's a potential downside.
Right. It suggests that while maybe some domestic industries benefit, there could be costs to the overall economy.
This whole climate of uncertainty, it seems to be pushing even central banks to change how they manage their money. There's this move towards gold. Why is that?
Well, gold is often seen as a safe haven asset when things feel unstable economically or geopolitically. So, seeing the share of U.S. dollars in foreign reserves dip a bit while central banks buy more gold, it suggests they want to diversify, hedge against currency swings or wider economic shocks.
And it's not just small countries doing this, right? It's some big players.
Exactly. We're talking central banks in major economies like China, India, Russia, Japan. They've all been actively boosting their gold reserves.
Wow.
When institutions that big shift their assets like that, it really underlines the level of global concern about where things are heading with the economy and trade. What do you think makes gold so appealing to them right now, specifically?
Maybe just perceived stability. compared to currencies that could get knocked around by, sudden policy changes or geopolitical events. Seems safer.
Yeah, perhaps.
Now, despite all this talk about trade wars and, decoupling, the U.S. and China are still deeply linked economically, aren't they?
Oh, absolutely. Yeah, the U.S. deficit with China got smaller, but it was still huge in 2024, nearly $300 billion.
295 billion, yeah.
And look at what the U.S. imports from China. Tons of computers, electronics, electrical gear, all sorts of manufactured goods. The dependence is still very real.
But there is that clear trend of the U.S. looking elsewhere for imports. Mexico's really stepped up.
That's a very obvious shift, yeah. China's share of U.S. imports has definitely dropped. And in 2024, Mexico actually became the #1 source of goods imported by the U.S., overtaking China.
Overtaking China. Wow.
Yeah, and Vietnam's share has grown a lot too. But, and this is important, even with these shifts, China is still the dominant supplier for many specific things because of its manufacturing scale and, frankly, cost advantages.
So untangling this web is like much slower and messier than just slapping on tariffs.
Exactly. It's complex.
Okay, let's flip it. What about China's side? How are they handling these pressures?
What's interesting, while their surplus with the U.S. has come down, their overall global trade surplus has actually surged.
Really?
It shows they've been successful at finding other markets, diversifying away from just the U.S., and also boosting their strength in new areas. They've made a strategic push into new markets and are exporting more high-tech stuff. Think EVs, advanced batteries, solar panels.
So they're adapting, finding new avenues, and presumably they have ways to push back if they want to, right? Retaliation options.
They certainly do, yeah. They have a toolkit. One option is letting their currency, the yuan, weaken further, makes their exports cheaper. We've seen some of that already. They also have huge leverage with rare earth elements essential for tech. Restricting those exports could really bite.
Right, critical materials.
And then there's their massive holdings of U.S. Treasury bonds. Selling those off is another potential lever, though that's a much more complicated move with global consequences.
Sounds like a really delicate situation, high stakes for everyone.
Eh,
Now, we
yeah.
mentioned Mexico and Vietnam benefiting from the U.S. diversifying imports. Are there risks for them in this new setup?
That's a crucial question. Yes, more trade with the U.S. is good news for them, but it also makes them potentially more dependent.
Right.
Take Vietnam. Its economy is heavily exposed to both the U.S. and China. So a big downturn or policy shift in either one could really hurt them.
Vulnerable.
Yeah. And similarly, Mexico and Canada rely hugely on U.S. exports. Countries like Malaysia and Chile depend a lot on China's demand. This kind of trade concentration, it creates its own set of risks.
Okay, let's try and pull this all together. As we wrap up this deep dive, what are the main things you think our listeners should take away about global trade right now?
Okay, well, first, there's a definite slowdown in global trade growth, especially for physical goods. Second, those U.S.-China tensions. They're a huge factor, with higher, less predictable tariffs driving changes. Third, this is causing a reshuffle, Mexico, Vietnam gaining U.S. import share, but China is still dominant in many areas. And fourth, all this trade stuff is tangled up with bigger economic worries, potential U.S. inflation, softer global growth, and even central banks hedging with gold.
Okay, that's a great summary. So as you sit with all this rising trade friction, these supply chain shifts, what are the long-term implications we might see for, global economic stability, the future shape of international trade?
And maybe building on that, here's a question for you to mull over. With central banks turning to gold because of all this trade uncertainty, could that signal something deeper? Maybe a fundamental shift starting in the global financial system that you'll want to keep an eye on?
Definitely some big questions there, some really crucial insights to think about. Thanks for walking through this complex picture with me. We really hope this deep dive has brought some clarity for you on the rapidly changing world of global trade.